Welcome to episode 3 of season 3 of the Your Money podcast. I'm Peter Cishecki, president of Everything Financial Group, and your host today. No David Pratt. They're letting me fly solo. That's dangerous at best, but I'm going to give it a shot. Today we have Truong from Everything Financial Group. He's one of our associate financial advisors, but also our in-house mortgage broker. And Vitri also runs the Everything Financial Mortgage Group, the solution to all your mortgage needs. So today he's going to myth bust, wow, I said that, and educate us on mortgages and how mortgages are not just a product, they're part of the solution of the Omni Formula financial plan. So welcome, Vitri.
Thanks, Peter. Great topic. This is a passion of mine. I love talking about stuff like this. Hoping that today we can share advice and help people make good decisions and keep them from being house rich and cash poor, and maybe help some self-employed people gain some insight as well, and overall help you pay down your mortgage faster while also being able to retire and live a good retirement.
So let's make sure we educate the public on the modern day mortgage solutions, not those things our parents and grandparents used to say to us about you must do this because, well, that's what I was told.
Absolutely. Yeah, no, the world's a very different place than it was in 1980, 1990.
So last century. God, we're really dating ourselves now. Well, perfect. Let's get right to it. So Vitri, what we're going to do today is provide people really generic education and the questions they should ask. So the whole point of the podcast, obviously, is to teach people to ask the questions they didn't even know they're supposed to ask. So like you just said, we're going to turn the mortgage acquisition, if you will, or purchase more into an informative solution into just the old standard, like the banks do. Everybody gets a 5-year mortgage, because apparently I didn't realize, I did, being sarcastic, that was the only type there was. But according to the bank, that's the only one, correct?
Absolutely. Yeah, they don't talk about 1 and 2 years very much, do they?
No, they don't. So real estate, there's the big one. I mean, your home being probably your most important financial asset. Why does a mortgage need to be the right solution and not a commission product? What is the importance of picking the right mortgage for your financial plan and not just picking the mortgage that makes the broker a lot more money?
Oh, absolutely. You have to pick the right one because life happens to us way too quickly these days, right? The average mortgage changes. Well, you change your mortgage on average every 3 years because life has thrown you that much of a curveball where you need to go and do something different than what you were doing, right? So for 5 years, that's a long time these days.
Yeah, I've heard this now, correct me if I'm wrong, but isn't the average mortgage changed about every 3 years or something like that?
38 months, I think, is the stat.
So if people are changing that frequently, again, sarcastic, almost rhetorical, who's really making the money?
Well, it's the people who are refinancing you and, turning you, break your 5-year mortgage, pay this penalty, and get a new 5-year mortgage.
So let's stick with this item number 1 on the list here of all the items we have for now. So and I know we do this again, this is for the viewers too and the listeners of the podcast, but when a person at the bank approaches you about changing your mortgage, because it is such a key purchase, what would be one of the first questions you should ask them?
What's the cost? Like, what's the cost and what's the benefit? You really have to get them to show you the numbers.
Yeah, no, isn't there, what's that term you've told me about? Oh, when they tell you, here's the one I love. We're just going to blend the rate.
Blend and extend, yeah. Yeah, that's a big one. You're not getting the best deal on blend and extends normally. You're getting... It looks lower because they're blending a lower rate with your higher rate, and you think, oh, I'm somewhere in between. That must be good. But you're at kind of the mercy of what they'll offer on that next part of it. You could probably get a better deal somewhere else, but they're not going to tell you that. They're not going to say, well, if you told me to be more competitive, we would be. Here's the rate we're going to give you.
Okay, so more myth busting here, blend and extend and all these other terminologies. So let's help educate the public on another one here. And I know we do this as part of the financial plan because we're not selling mortgages. We're providing solutions, with a mortgage being one of those things. But I found this so bizarre when I learned this years and years ago. about what's the myth of biweekly payments, and what would be the alternative to a biweekly payment, if you will.
Well, a biweekly payment is the same as a monthly payment, but you have 26 payments in a year just to match your pay stub instead of 12 monthlies. But you're not paying down the mortgage any faster. The only way to pay down your mortgage faster is actually to make an accelerated biweekly payment, which all that means is you're adding the equivalent of 1 month of extra payments in a year. Yeah.
So isn't that extra payment though, because I know I did this, I calculated this once before with one of those great software programs you designed for us with the Excel program, but isn't biweekly still though interest and principal?
Yeah, it makes no difference. It's just one of these things that people have been convinced that it's going to pay down your mortgage faster. It's the only way to pay down your mortgage faster is to put more money towards it.
I know. I can't remember the last time I went to buy something and it actually showed the price of something. No one knows the price of anything anymore. It's this much per month or it's this much biweekly. No one really tells you what the true price is. So isn't it quicker though if you were so disciplined or had a financial planning firm like Everything Financial to show you how to save that extra payment and then put that extra payment straight against the principal instead of interest and principal? Wouldn't you save a few months at least, or maybe more?
Quite a bit more, Peter. As we've seen with some of the numbers that we've run, if you instead take that extra payment and put it towards, say, a TFSA managed by a good portfolio manager, that you could quite quickly accumulate a lot of savings there and pay down your mortgage about 10% faster is what we've seen.
So on the standard 25 to 30 years, it's 2.5 to 3 years faster. And I can't even think in a high interest rate climate or a low interest rate climate, the bottom line is you're going to save a heck of a lot of interest in 2.5 and 3 years.
Oh, huge, huge. And also, not only that, because you're investing in a TFSA, if life were to happen to you, as it does most people, you have a pile of cash there to take care of some of those curveballs.
Yeah, there's that emergency fund we've talked about before in our financial plan.
Right. Otherwise, you're just falling into the bank's trap of, oh, you need money. Now we have to refinance you. Let's break this mortgage and get a new one.
Yeah, what I can't believe with this stuff is during the high interest rate times of 2022, and we would see people who had just refinanced, because of the higher rates, or their mortgage just happened to come due. Fair enough, they refinanced.
Yep.
And 3, 4, 5, 6 months into this, that high interest time, they were getting approached. I just found this mind-boggling. Actually, I found it quite disgusting, to tell you the truth, that they were being approached by banks to refinance again because, no word of a lie, people, this happened. Bankers were telling people that interest rates are going to be 18%, just like they were in the 80s. So even though we just refinanced you at 4 and 5%, you should do it again to lock in for even longer. How do they get away with that?
I don't know how they get away with it, Peter. It's remarkable what they can get away with, and frankly, what people will believe. I think you really need to ask those questions and find people you trust to verify if this is in fact going to happen or what the likelihood is. You might think it's something different.
Now, I know at Everything Financial, before I get into the next question I want to address here, but I know at Everything Financial, we disclose everything. Don't bankers, I'm saying bankers, I don't mean bankers actually, don't mortgage brokers have to disclose the commission they're earning?
They do, but it happens so late in the process. The mortgage is already approved, ready to go. You just sign here.
Yeah, we were talking in an earlier episode, episode 2, I think, this season, about letter of engagement and full disclosure, and that's something I think should be done right in the beginning. But also, and I don't know the answer to this, that's what I'm going to ask you, because I don't know everything, people. Contrary to no, I don't know everything. Trust me. But they have to disclose that, great, late in the process. But what they don't have to disclose is the difference. Like, what would be the difference between a simple interest home equity line of credit or a 1 or a 2 year or a variable or a 5 year? They just have to disclose what the one they're providing is. Is that correct then?
Exactly. So like a 5-year fixed mortgage will probably pay anywhere from 1%, 1.2%. A line of credit could be as low as 0.3%. So it's a big gap there.
It's like
right?
400% difference.
Yeah.
Wow,
Yeah.
that's the difference between, a 74 Pinto and a Tesla, I guess.
Yeah, you won't.
There's a whole story, people, about the 74 Pinto. I'll talk about it in another episode.
You won't see a lot of brokers flogging 1 and 2 year rates right now. Like it just doesn't happen.
I know recently when the interest rates were going up, I know you were talking to a lot of people, and we talked about this in the office in White Rock, about a 1 and 2 year rate being a good stopgap. Like, because you don't know. I mean, it's like when we talk about investments and I make the jokes about having a rear view mirror. You don't know what interest rates for sure are going to do, but the government's going to want low interest rates in the not too distant future, 2-3 years, because it is tied to inflation. So I'm seeing mortgages really quickly, not much different from the rate chasing of mutual funds in a sense that, sell with fear, sell with misinformation, take your commission and run and never see the person again.
Yeah, unfortunately for a lot of the industry, that's the case because you often do not go back to the same person year after year after year. It's oftentimes someone completely new. You don't have a relationship with them. The person selling you that mortgage doesn't have to look you in the eye and say, well, oops.
Now, this isn't meant to be self-serving. This is for information for people. So I don't want it to sound, it's going to sound wrong no matter how I put this. But isn't that really one of the reasons, when you became available, you were like a free agent years ago, and we hired you to do this at Everything Financial, but I know you because I knew you for 5 years roughly before that, working at one of the bigger companies.
Yep.
As a quality individual and someone who is beyond reproach. This guy is so honest. It's great. But one of the reasons you joined us was because of the full disclosure and not because you had the opportunity to go work for mortgage companies and just, as you said, flog mortgages.
Yeah.
You could have done that. But you, like me, had the same belief where it's part of a bigger picture.
Wholeheartedly, Peter. Thank you for saying that. I guess checks literally in the mail?
No, I think that's the 15th and 30th. I'm not sure when we're recording this, but yeah, soon.
Yeah. But because your vision and mine line up precisely because I believe the debt management is so often overlooked in everyone's financial plan that you go through life thinking one thing, whereas if you had pivoted a little bit, done something else, you would have had such a better result by properly managing that debt, right? Like one of those biggest myths we often face is clients in pre-retirement thinking, oh man, I'm never going to pay off this mortgage. How am I going to do this? And then we bust the myth and going, you actually don't. Like we can do this other thing where we can create a pile of cash that makes a payment, which is kind of the same thing.
Yeah, exactly. And I know one thing we do is make sure to kind of, if you will, put our money where our mouth is, people. We do that at Everything Financial, and we've disclosed this on the website. In a lot of cases, if we're going to recommend something and it's going to cost money, there's fees involved,
Yep.
We actually buck up and pay the fees because if it's not the client's idea, why should they pay it? And we'll cover like a legal or an appraisal fee,
Yep.
and that's always fully disclosed. And it's not every case, obviously, but it is in many cases. If you're going to be given advice that's going to cost you money, then I guess the moral of the story is it shouldn't cost you money. So, okay, let's get into a little more education here. Not really the numbers, but just for full disclosure, what is the real difference in the terminology and how it's calculated between simple interest, which is generally what's used in a home equity line of credit? Now, we're not worrying about this as a product right now, but just for definition, or compound interest. What's really the difference in how they're calculated?
Yeah, so simple interest is how everyone thinks interest is calculated. So you take your annual rate, you divide that by 365, and you charge a little bit each day, right? So it's more fair. It's based on what the balance is at the day. Compound interest is where you take the rate, and depending on how often it compounds, in mortgages, it's semi-annually or monthly in some cases, and then you add the rate there, and so the interest is compounded on the interest throughout the year.
I guess in layman's terms, if you turn that the other way around, if you were, not that anyone's going to make 10% in the market these days, but for math purposes, if you had $100 and it's simple interest, So let's look at it from the bank perspective. And 10% means $10.
Yep.
And in year 2, it's still $10. And year 3, and so on, it's still $10. But in compound interest, it's $10 in year 1, but it's 10% on 110 in year 2, and so on and so on. And I was actually just with some people from Australia, some clients of mine recently, and we were talking about interest rates actually. And I know years ago, this is not a plug for them, this is just reality. Manulife Bank,
Yep.
Through the Manulife One product, and this has got to be at least 22, 23, 24 years ago, I'm thinking, somewhere around there.
Yep.
Back at the turn of the century. That sounds so funny.
Well, Manulife copied what they were doing in Australia.
In Australia, that's right. And the president at the time brought it over, because I do know this in Australia. If you're a really safe risk, you get a simple interest mortgage. But if you're a higher risk person, you actually get a compound interest mortgage.
Yeah.
As opposed to here, where all of a sudden compound interest came in and it's never gone away.
Yeah, no, they got it right. Like if you're higher risk, they're forcing you to pay that back through a regular mortgage instead of just hoping one day you will. So we kind of got it backwards here.
Wow.
Right?
I think there's certain institutions that make more money that way, though. But again, it's not one item is best or one is the only solution. I mean, a lot of times you can do a hybrid of simple interest and compound interest, I guess.
100%. That's what we do for, I'd say 80, 90% of our clients is they would have some sort of that hybrid approach as they're, in their 30s and 40s and whatnot. And then we would kind of change gears as they get a little bit older and don't need that fixed mortgage portion.
Yeah, so look for the best solution for the individual.
Yeah.
Not one size fits all.
Yeah, it's all based on where you are in life and what your goals happen to be and, what we know about your future plans.
So keeping simple interest is one of those options too, but tying this together, mortgage being your biggest asset, and I'm, a proponent of how to make money is pay way less than taxes. So mortgage tax deductibility. And I hear this with people all the time. They think it's a U.S. thing or people who run a business out of their house. But isn't there other ways to tax deduct your mortgage?
Absolutely. You can tax deduct your mortgage if you take any piece of your equity to make some sort of an investment. So that could be real estate's the most famous one, but you could, like we said, put it into your financial plan as well.
So I know we have a spreadsheet that shows this. I've seen examples where writing off a portion of your mortgage. Now, the key, though, for people, the education part is taking the tax savings that this provides and then having the discipline to apply that tax savings, though, against the principal and actually make sure you pay down that mortgage, not buy, I don't know, a new 60-inch smart TV or something like that. ATVs, yeah, it's things like that. Yeah, so that's the key. To make it work, if you're going to save money on taxes, use the tax savings to pay down your mortgage. And that can make a significant difference, I guess. Like we're talking years.
Oh, man. Yeah, we just did one for a client. They're in the 53.5% tax bracket. And it's...
Oh, but BC doesn't have high taxes. Ask Oregon. In case you're watching this in a few years from now, he was our premier at the time we recorded this.
Yeah, we took their 25-year mortgage down to 12.
Just through tax savings.
Because he's in such a high tax bracket, right?
So
Yeah.
Don't spend more money, just spend it smarter and get the taxes back.
Exactly.
Which leads into what you talked about earlier. So let's just expand on that a little bit. So run through again a little more detail about this TFSA. We're going to show up a graph here on the screen. How to use a TFSA. Just provide me a little more clarity. How to use a TFSA to pay down your mortgage.
Yeah, so TFSA. So let's say that your payment is, fixed at this level, but you wanted to pay it down faster. Let's say you wanted to put it a couple extra $100 a month or a couple extra $100 a pay. Well, instead of doing that, let's run the numbers on if you took that same extra payment and put that towards your TFSA and then compound that over the years, because now compound interest is working in your favor,
Right.
Because you're compounding interest gains upon gains with your TFSA. right? We run those two
Yeah,
numbers.
you're saving that extra money and you're not paying tax on it too.
Yeah, and at some point your TFSA is growing, but your debt's coming down. So at some point the two meet. And that's usually, as we've seen with our spreadsheet, about 2 to 3 years sooner than just doing it normally.
Yeah, and then I guess, like you said, then you have the TFSA, you have more freedom. The TFSA could be put towards retirement. At that point, you can say, well, I'm technically debt-free on my net worth statement. That we talked about that a few episodes ago. And then you can say, well, maybe I'll postpone being completely debt-free for a few years and use some of that money for travel or special thing for the family. And I guess that really depends on your plan and what the market's like at the time. Like if the market is having one of those real good growth periods, maybe you take some of that growth and do something for yourself.
Exactly. And for some clients, we've found that TFSA has grown to a point, well, projected, that it will actually make the mortgage payment of what's left over.
Oh, well, yeah. And again, best way to get ahead, use somebody else's money. So this way you're kind of using your savings, but you're also using your tax savings through the TFSA to get you further ahead. And I guess for clarity too, for people, if you take money out of the tax saving, out of your TFSA, take money out of your TFSA, that money can be put back the following calendar year or any calendar year after that. Now, I had this with my client recently. He said, if I take money out of my TFSA, do I get the contribution back? Well, say your contributions to your TFSA, let's just say it was $50,000 just for easy math. But you cash in the TFSA at $65,000, you actually get to put back the whole $65,000 the following calendar year or later, not just the 50 plus any other future contribution. Right. So you've gained a lot more flexibility that way.
Yeah.
So let's get into the second half of this podcast, a subject near and dear to my heart. Fees about mortgages, because I hate fees. It's not that I hate fees, I just hate the lack of disclosure of fees for starters. So we're going to talk about the fees about mortgages and the do's and don'ts about those fees. So let's start off with a line of credit. Having a line of credit for times when the market's crappy, you need money, using a line of credit for what you need, etc. What would be involved in fees on a line of credit, paying it off? What are the kind of do's and don'ts to look for in a line of credit?
Yeah, no, line of credit is fantastic for financial planning. It just gives you so much flexibility and access to your equity. The fees for setting it up is pretty much the same as a mortgage. So it's registered on title as a mortgage. So there's only one little tick box on your registration that differentiates it between a mortgage and a HELOC. So you're looking at legal fees and appraisal fees. There shouldn't be any other fees on that. And the beauty is, if you were to move and you have to get rid of this mortgage, there are no penalties to get out of it. And the only thing that you would have to pay would be maybe the title discharge fee from land titles.
And what would that be about?
It'd be about $75.
Okay. So what if it's not a line of credit attached to a mortgage? So not, what did you say, registered against a mortgage? So I guess that's not a secure line of credit. What would be the difference in that type of line of credit?
Well, your rate would be through the roof on one of those. Like they're typically prime plus 3, 4, 5 sometimes I've seen. And it's all based on who you are, what your credit rating is, how much the banker likes you, that sort of thing.
So prime plus 3, 4, 5 versus prime plus what on a registered one?
On a typical one, it's prime plus a half.
Oh, okay. That's significant.
We've gotten clients prime plus 0. We've gotten one prime minus something. So it varies depending on which institution you use and kind of your plan as well, right?
Okay. So that's the difference in knowing. So the terminology for people to look for is either registered or secured line of credit or home equity line of credit versus just line of credit.
Home equity line of credit is typically what we use. So you've heard the term HELOC thrown around.
Yeah.
That's what it is.
So when we were talking in our second episode this season about information to provide when doing your financial plan, and I talked about statements, there's a reason to bring in the statement to Vitri and let them look at your line of credit statement if you have one. What type do you have and how much of a surplus are you paying on this interest? Because if you're paying on a home equity prime plus 1,
which we've seen.
Yeah, you're getting ripped off.
Yeah, we've seen a lot of clients who've always just gone into the bank. They've never dealt with any outside mortgage broker or gotten any outside advice, and they're paying prime plus 1 and have been for years. And I thought, oh, that's just normal. Everyone's doing that.
So why would the bank, more of my cynicism, why would the bank provide them prime plus 1? It couldn't be to make more money, could it?
Maybe.
Yeah, we're going to give them the benefit. No, we're not giving them the benefit of the doubt. It's a commission grab, or the person at the bank just doesn't know better, and they're just doing what they're being told from someone up above.
Oh, no. The training it's prime plus 1, and you're a special client to get prime plus half.
Seriously?
It absolutely is.
I wasn't even serious when I was asking that.
Yeah,
I was trying to give them, I honestly, if I know rare people, was trying to give them the benefit of the doubt. I thought maybe they did. So they're actually coached into, like, we're giving you it's like the old company Sears, where everything was always on sale. So you're, you got to be really old to know what I'm talking about. But so they're doing that just to make people think they're getting something special. And you're here to tell us they're not. That's the norm.
It's hard coded into their system at prime plus 1. They actually have to, like, the person doing it actually has to request a discount.
Holy jeez. When the discount should just automatically be, or not even calling it a discount, just the prime plus a half rate should be provided. And a prime, sorry, not plus, but prime is an exceptional type thing. So don't count on that, but you should count on them prime plus a half at worst.
Yeah, it's very similar to how banks post, our posted rate is this, but you're a special client, so you're going to get this. But no one ever takes this up here. It's just like that.
The special client is the one with $50 or $500,000. Doesn't matter. You're a special client today because it's Sunday or Tuesday or Wednesday, whatever. I know banks, I love it. So here's the thing. Some advice or something built into a financial plan about not paying off your mortgage in retirement because only your adult children will really benefit from it. So using your retirement to enjoy your retirement. So what is the change in your mortgage when you hit retirement? What kind of things should you look for?
Well, like you said there, when you're retired, so you've stopped working, you're no longer making any income, stop making principal payments because, like we said, that only goes to your children, right? You're using the money that you've got now, that you've saved up and whatnot, that should be going towards enjoying your golden years, if you can call it that.
Gray years.
Gray. You should enjoy retirement when you get to that stage. Right? Paying off a principal serves no purpose. Chances are you might not be able to pay it off anyways.
All I think of when you say that is the old adage, house rich, cash poor.
Absolutely. Most Canadians are working towards that very retirement where they're house rich and cash poor.
I had someone recently, we were doing a financial plan for them, and their new clients came in, and they were in their 60s. They were really retired. They were retired or just about to retire. And they were looking at, they had a fairly new mortgage, and it was a 25-year amortization. And I remember the first thing I said to them was, why? Like, what's the point? Like, why would you spend, you're never going to pay this off before you're dead.
Yep.
So why not look at your mortgage as simply a really well equity rent payment? You own the property. The only growth at that point in your property, correct me if I'm wrong, should really be the equity it increases by. It's an investment, just like buying a TFSA or an RSP or any other investment. You're just making a payment on it. Because think about it, in normal times, an average interest rate of 3 or 4%, and your property is growing at 5 or 6, but it's also growing essentially tax-free because it's your principal residence, the gains are not taxable. That's not a bad investment. And it's a secure item because, again, it's going to disperse to your kids. Or you may liquidate it when you're 80 years old and maybe need some care or something like that. You have another asset besides your TFSAs, your RSPs, your pension, et cetera, et cetera, et cetera. There's nothing wrong with having that as part of your equity.
No, and that's what I love about what we do is we tell clients the good news. Our financial plan, goal number 1 is to keep you in your home, right? It's the home you love.
As long as possible.
Yeah. How do we make sure that you can still sustain this rent payment? We had one client where they were going to cash out all of their investments to take their mortgage to zero, then they'd have nothing left to eat. But once we moved them over to our portfolio managers, we found that the interest only off of that covered more than half that interest payment if they were to switch to that interest only and not be in a 25-year mortgage.
Well, that makes kind of way more sense to look at doing it that way as opposed to just spending every dime you have, to pay a mortgage payment and not have anything to live on, which makes no sense. But I get, you know what though? A lot of that is drilled into us from our parents and from their parents because they didn't have all these other options 60, 70 years ago. Your house was your only item.
Your house is also $50,000, $100,000. They didn't have the giant $1 million mortgages that we have now.
Yeah, the mortgages have definitely gone up faster than inflation over the past years with property. I mean, there's only so much land, so prices go up. But again, that brings us back to why that asset, the house, is not a product. It's part of an overall strategy.
Yeah, you have to look at your net worth and how do you maintain that net worth in retirement or even increase it a little bit depending on how your financial planning goes, right?
Okay, so let's expand on the mortgage knowledge here and change gears a little bit. Talking about something you mentioned earlier that just kind of tweaked my interest. Talking about a variable, you said earlier about variable and 1 or 2 year one or 2 year fixed rate mortgages. So short term is what I'm trying to say. Rented lips today, for your final home. So why variable? Why short term?
Well, you have to cynically do the opposite of what the banks are pushing you to do.
Well, I find that so shocking because they wouldn't be in it for money.
A variable rate, just historically, you win 7 out of 10 years, meaning if you had gone variable and just wrote it out, you would have paid less interest in 7 out of those 10 years.
And this even works when interest rates are going, as they did in 2022, going through the roof for a period of time. This still works out to be beneficial, though there may be some short-term pain.
Yeah, in general, for sure, because we're not going to get rates rising forever. And you want to be able to write it down.
It's funny because banks talk about with their, as I said earlier, their fear factor about 18% rates in the early 80s. But when you look back, horrible rates. I remember my parents had a mortgage then, and I was studying this stuff in school then. But it was actually still a really short period of time.
Yeah, no, that period in the 80s wasn't long, right?
Yeah, so as probably 2022 to 2023, same idea. So what is really the commission difference in a variable versus, say, the standard bank chosen promoted 5-year?
Well, they're more or less the same, the variable and the fixed. So they often will try to advise you one versus the other, whereas they're ignoring the question that, it's a 5-year.
Right.
So
the rate's the same, but variable gives you a lower
starting point, and then you're taking the risk that rates will go up. And if there's enough of a discount, you go variable.
Also, and correct me, I could be wrong with this, so I'm just going by all the things you've told me over the years, but can't with variable you change to another type of mortgage, like a 1 or a 2 year? Yeah. Is it without a fee or a reduced fee?
Yeah, no. There's no fee as long as you lock in with a minimum term of whatever's remaining. So if you have 1.5 years remaining, you have to lock into a 2-year.
Okay, so if you were in a variable during high interest rate times or interest rate times that are really getting out of whack and just out of reach for your own, maybe it's not the best financial decision, but maybe emotionally or it helps you sleep at night, you could still have the security of knowing you can lock in with a variable, whereas if you're with a 5-year to begin with, you can't really change because you're going to pay fees.
Yeah, so we've actually advised clients a lot of times when the rates have been going up to go back to their bank and go, well, can I lock in for 1 and 2 years? Like, what will you give me for that? Because they've been listening to the news and can't sleep at night. And despite what we advise, sleeping at night's kind of important.
So I don't do that very often, but hey.
So if it helps you to lock in for 1 or 2 years maximum, don't lock in any longer, then that's the right move for you.
It's amazing how fast 1 or 2 years goes in the financial planning world. Yeah. It's like to clients, oh, wait a minute, 2 years has passed already. I know. So we talked a bit ago about house rich, cash poor. Let's expand on that. So the idea is to not be house rich and cash poor, not to pay down your mortgage.
Yeah, so it sounds like the opposite, doesn't it?
Yeah. Okay. So I want to get this right for people. So by doing this though and investing, what are you helping to prevent later on in life?
Well, exactly. We're helping to prevent that cash poor situation and house rich, because there are products out there that, will say they fix that, and those are things like reverse mortgages and whatnot, right?
So if you've come to Everything Financial way too late, what's the solution before a reverse mortgage? And again, reverse mortgage may be a solution, but what would you try and do first? And then when would the reverse mortgage come into play?
Yeah, no, great question. A lot of clients come to us. Our phone is ringing off the hook about reverse mortgages because a lot of Canadians are in a situation where they don't have any cash and they've got all this equity. But in a lot of those cases, if you did a home equity line of credit like we've talked about, start there, and you don't actually have to pay it off or anything like that. But start there, go go interest only for as long as you can afford with whatever your retirement income is. And as that balance grows over time, because a line of credit can grow, you can capitalize that interest. There are ways to do that. You do that for as long as you can. And then at that point, once you've kind of gone through all those options and it's getting to a point where it's kind of painful, then you switch to a reverse mortgage. That should be kind of the last result, or lender of last resort, I guess.
Well, if it's the last resort, then that's probably our last item. So I guess the key takeaway from this is, Vitri, that the mortgage isn't a product. It's something looked at very early in the financial planning stages of the Omni formula. I know we look at it very early, but for people who are just trying to use the podcast as information, they're going to a certain firm, don't let someone sell them a mortgage, for lack of a better word, like it's the only solution. It's just part of the overall solution.
Absolutely. And just to clarify, we don't hate reverse mortgages. They're a great product. We just happen to be very careful on who we recommend get into those.
Yeah, right. And I'm sure they have different fees. Different companies provide them for different costs. So we want to go with the one that's the right one for the client for the right situation.
Exactly.
Yeah. So if people are now completely confused, or you've now piqued their interest and they want to know more information, how do the viewers and the listeners find you?
Well, I am at Everything Financial. We go on the website and there I am. Or give our office a call. Any of the offices, it all kind of goes to the same place, and they'll put you in touch with me.
Perfect. Well, thanks for your time, Vitri. People, that's a wrap for episode number 3 of the Your Money podcast. We're going to be back with David Pratt in the co-host chair, and I'll just be blabbing on about statements and fees and things that I usually blab on about in episode 4. So catch us online at everythingfinancial.com, or go to YouTube, go to the Everything Financial Group YouTube channel to catch all these episodes and other items we post. And we'll see you soon in episode 4.